Well, there's been a lot of talk lately about silver maybe flashing the kind of warning that investors usually only understand after the move is already halfway over. So, in this video, we're going to separate signal from storytelling, and you are going to walk away feeling sharper about what may be building in this market. It is Monday, April 13th in New York, and comment below with the day and date you're watching from. And real quick, if you value this kind of work, support the channel by subscribing and by commenting John AG Best, so I know you're here with me. Because right now, the silver conversation is getting weird in a hurry. On one side, you've got people saying this whole thing is overcooked, overhyped, and one bad pullback away from embarrassing everyone who got too excited. On the other side, you've got people acting like silver is one headline away from teleporting to the moon. And honestly, neither side is helping you much. What matters is this. There are a few moving pieces coming together at the same time. And when you stack them on top of each other, you start to see why the warnings around silver are getting louder. First, the broad setup still looks tight. Based on recently published numbers, the silver market is staring at yet another annual deficit this year, which would make it roughly half a dozen straight years where demand stays above supply. At the same time, physical investment is expected to climb again, while total supply growth looks modest, and mine output is not exploding. That doesn't guarantee a straight line higher, but it does tell you the market is not swimming in excess metal. And that matters, because silver is not just a shiny rock people buy when they're nervous. It's money to some people. It's an industrial input to others. It's a strategic material to governments. And depending on the week, it can behave like all three at once. That's where things start getting interesting. Because when a market has monetary demand, industrial demand, policy attention, and inventory anxiety all rubbing shoulders in the same room, price action can get jumpy fast. Not smooth, not polite, fast. Now, let's talk about the inventory side, because this is where a lot of the fear is coming from. The latest exchange warehouse data shows registered silver sitting in the ballpark of the high 70 million ounce area. That is not nothing, obviously, but it is small enough that people keep staring at it and asking the same question. What happens if too many claims suddenly want to act like owners at the same time? And here's where I want to slow this down. Low registered inventory is a warning light. It is not automatically a fire. Those are not the same thing. A lot of traders never intend to take metal out. A lot of positions are financial. A lot of exposure gets rolled. And a lot of dramatic commentary online skips that part, because saying structural tightness with uncertain timing does not hit the same as saying this thing breaks tomorrow. Still, the warning is real, because even if you do not get some cinematic overnight failure, a market can reprice before it snaps. In fact, most of the time that's exactly what markets try to do. They squeeze, they ration, they make you pay up, they slow demand, they invite scrap, they punish late buyers. That's usually how the pressure comes out. And silver has enough pressure points now that the repricing argument is a lot more credible than the Carnival Barker version of instant collapse. From recent market updates, silver also came into this year after a monstrous run. And even after cooling off from the January spike, the price was still up meaningfully year to date when industry groups published their latest outlook. That tells you something important. The market has already been trying to adjust. The warning isn't arriving in a dead market. It's arriving in a market that already knows something's off. And there's another layer. The United States officially added silver to its final list of critical minerals late last year. That is not some random internet rumor. That is a real policy shift. And it matters because once a metal moves from useful commodity into strategic concern, the conversation changes. Now, you're not just talking about jewelry demand or coin demand or even electronics. Now, you're talking about supply security, national resilience, and what happens when the wrong country controls too much of the chain. That doesn't automatically mean there's a government-backed silver floor coming tomorrow. And this is where I want to push back a little on the more aggressive silver crowd. Critical mineral status is meaningful. It is not magic. It does not mean policymakers wake up and declare an instant minimum price. It does not mean every ounce gets treated like a military secret. And it definitely does not mean every mining stock suddenly turns into a rocket ship with a pulse. What it does mean is that silver is being viewed through a more strategic lens than it was before. And once that happens, the market starts looking ahead. Could there be some kind of coordinated strategy among Western partners on key minerals? Could silver benefit indirectly from that? Could policy support show up in subtler ways before anybody ever uses the words price floor? Yes, all of that is possible. And that possibility got more attention because reporting this month said the United States and Europe are nearing a cooperation framework on critical minerals across the whole value chain, from exploration all the way through recycling and recovery. Meanwhile, Washington and Canberra just expanded financial support for critical mineral projects, with commitments in the multi-billion-dollar range aimed at supply chain resilience and reducing dependence on China. That is not a silver-specific rescue, but it is a giant neon sign that the strategic minerals race is not theoretical anymore. Now ask yourself something. If governments are moving to secure materials, if investors are still buying physical, if exchange inventories remain tight enough to spark constant debate, and if silver has already been dragged into the critical minerals conversation, then what exactly are you supposed to call that? Because to me, that looks less like a sleepy commodity story and more like the early chapters of a strategic repricing story. And that's before we even get to the so-called black swan material. A lot of people love making lists of 10 disasters that could send silver vertical: energy shock, export controls, cyber disruption, war in producing regions, currency panic, new tech demand, all the big dramatic stuff. Now, I'm not against scenario planning. Actually, I think it's useful. But here's the mistake people make. They treat every scenario like a prediction when most of them should be treated like accelerants. That's different. If silver is already in a market with deficits, strategic attention, concentrated supply chains, and sticky investor interest, then a shock doesn't have to create the story from scratch. It only has to hit a market that is already stretched. That's how you get violent moves. Take energy. If something major disrupts shipping lanes or energy flows, silver doesn't just react because traders get emotional. It reacts because energy is embedded in mining, smelting, transport, refining, everything. A cost shock in the real world can turn into a pricing shock in metals faster than people expect. Take export controls. China's restrictions on rare earths over the past year gave the rest of the world a nice little preview of what concentration risk feels like when it stops being an academic phrase and starts messing with factories. Recent international energy analysis shows China accounted for a bit over 9/10 of refined output for magnet rare earths in the latest full-year data, and roughly the same overwhelming share in permanent magnet production. That is a choke point, not a theory, a choke point, in real life. And if you think that has nothing to do with silver, hold on. The broader lesson is what matters. When governments realize that strategic materials can be restricted, withheld, licensed, delayed, or weaponized, they stop thinking like passive buyers. They start thinking like planners. They start thinking like competitors. They start thinking like countries that do not want to be caught flat-footed in the next crunch. That mindset shift can spill over into silver even if silver is not the first domino. Now layer in demand. According to the latest Federal Minerals Summary, silver still has substantial industrial use across electronics, photovoltaics, antimicrobials, batteries, soldering, catalysts, and more. That diversity is one reason silver gets tricky. It is not dependent on one single use case. It shows up in a lot of places, which means demand can bend in one area and stay stubborn in another. At the same time, there is a real counterforce here that serious investors should not ignore. High prices invite substitution. Recent industry reporting shows solar manufacturers have been pushing harder toward copper and hybrid metallization because silver costs got too painful after the rally. In other words, silver's own strength can eventually create demand resistance. That doesn't kill the bull case, but it does matter, and you need to be adult enough to admit it. So no, this is not a one-way fairy tale where every pressure point automatically means silver goes berserk forever. But that's not the actual thesis anyway. The thesis is simpler. Silver doesn't need every bullish scenario to happen. It only needs enough tightness, enough strategic urgency, and enough investor attention to keep the market structurally uncomfortable. That's the word. Uncomfortable. And uncomfortable markets can do things that sound crazy right up until they do them. And there's one more thing people are not discussing enough. The United States is not exactly sitting in some perfect self-sufficient silver fortress. The latest federal data says U.S. mine output last year was around 1,100 metric tons, while net import reliance was roughly 3/4 of apparent consumption. Silver came from a handful of primary mines and a patchwork of byproduct operations. So when people talk as if supply can be scaled on command, no. Not really. This is not like flipping on a spare faucet in the basement. New ounces take time, capital, permitting, labor, and a price environment that stays supportive long enough for projects to matter. That delay is crucial. Because markets do not wait politely for the mining industry to catch up. They overshoot, they undershoot. They starve one part of the chain and then flood another. And silver is especially good at embarrassing anybody who thinks a straight line model is going to explain a market with both industrial pull and financial emotion baked into it. Also, notice what happened in rare earths when controls tightened. Recent energy analysis showed exporters needed licenses, automakers struggled to source magnets, and prices outside China jumped far above domestic Chinese levels. That's a reminder that supply stress does not need total stoppage to matter. Delays are enough, friction is enough, uncertainty is enough. You do not need a shut-off valve to create a premium market. And that brings me back to silver. Even if the loudest silver bulls end up being early on timing, they may still be directionally right on regime change. That's the phrase I keep coming back to, regime change. A market that used to be discussed mostly in terms of jewelry demand, coin demand, and occasional inflation hedging is now being discussed alongside defense inputs, strategic stockpiles, energy transition metals, and supply chain sovereignty. That is a different neighborhood. And when an asset moves into a different neighborhood, the price behavior can start following different rules. Now, some people take this whole theme and immediately sprint into junior miners, rare earth explorers, and every story stock with a patriotic press release and a map of North America on the website. I get it. The appeal is obvious. Rare earths matter. Niobium matters. Magnet materials matter. Domestic supply chains matter. And the case for that got stronger, not weaker, after the recent policy push. Recent energy market analysis shows demand for magnet rare earths has doubled since the middle of the last decade and is set to keep growing, while downstream bottlenecks outside China remain severe. And reporting this month shows US and European players are trying to stitch together new processing and magnet capacity because relying on one dominant supplier is starting to look reckless. So yes, there is a real critical minerals race underway. But don't let that truth trick you into thinking every explorer is a masterpiece. A macro theme can be right, while an individual stock pitch is still weak. A national security narrative can be real while a company's timeline is still messy. And a great story can still lead to terrible execution. That distinction matters. If you're successful, share your success story in the comments so others can stay motivated. Because what I think a lot of people are missing right now is that the biggest silver warning may not be panic, everything breaks tomorrow. The biggest warning may be that the market is slowly moving from a cheap metal mindset to a strategic metal mindset. And a lot of people still haven't updated their framework. They're still looking at silver like it's just another trade, just another chart, just another shiny thing that had a nice run. Meanwhile, the supply backdrop is tight, the policy backdrop is changing, the critical minerals backdrop is heating up, and the geopolitical backdrop keeps reminding the world that concentrated supply chains are fine right up until they aren't. That is why this could be the big one. Not because one single event guarantees some cartoonish price target, but because several medium-sized forces can hit the market at once. Persistent deficits, inventory sensitivity, strategic reclassification, Western supply chain scrambling, and a world that is suddenly a lot less casual about who controls key materials. That combination can do more than a headline scare ever could. So here's the bottom line. I am not telling you silver has to explode tomorrow. I am not telling you every warehouse headline means default. And I am definitely not telling you to chase every tiny mining stock with a dramatic presentation. I am telling you the warning signs are no longer isolated. They are starting to rhyme. And when markets start to rhyme across inventories, policy, geopolitics, and investor behavior at the same time, you pay attention. You don't have to lose your mind, but you do have to pay attention. Subscribe for the next update because this story is still developing, and the next round of policy details could matter more than most people think. And as always, this is here to help you think more clearly and ask better questions. It's education, not personal financial advice, and you should make every money decision like it's your own responsibility because it is.